Here, Flip Anything USA. So today I thought to talk about real estate funds. If you've noticed, there's a lot of the a lot of the fake gurus in general. Grant Cardone being, of course, one of the biggest ones, but there's some new ones too that have suddenly taken an interest into creating a fund, and I think the main reason that's driving that is that as the formula's changed because the interest is so much more expensive. You know, the money costs more. And a lot of people don't know how they work. And I just wondered, anybody watching here, has anybody been tempted to be in a fund? Grant Cardone's funds, what I've seen of them, rarely make more than 4.5% when they were producing. And I don't know the status of them, don't pretend to. I had somebody I did a video with, and they actually showed, let me see if I can show you this. They showed what they were making and what they could have or should have made had they not gotten in a fund compared to what they made being in a fund with Grant. And again, it now more than ever, it's really terrible because we're kind of in a declining market, and it doesn't make sense for anybody. I mean, I don't like funds anyways. I tell everybody just run. You make so much more money on your own. And by the way, I've got a webinar tonight. Don't if you want to learn how to make money in real estate, I'll show you how to do it. I've been doing it for 40 years. 43 years now, and industrial, commercial, the whole gambit. And you can go to FlipAnythingUSA.com, and you'll see a lot of new millionaires, people that have become millionaires while they've been in my class. Anyways, I just, hey, Russ, how you doing, buddy? Russ wrote, no, I was never tempted to be in a fund. Yeah, Russ here also is in the class, and Russ has already become, he's made multiple millions, just in the commercial real estate, which is what he wanted to learn about when he got in my class, and he's been like on steroids since, doing really, really well. Grant, good to see you in here, buddy. There's funds that are, some that are actually crashing, ones that have to refinance, right, that are coming up on having to refinance. I remember Grant Cardone talking about how his funds would. I remember he was saying that his funds would be safe even if he had a 15% vacancy. Well, that 15% vacancy pales in comparison to your interest rate doubling, right? And I have no clue as to the status of Grant Cardone's. Some people say, oh, his funds are going to crash and this and that. I have no opinion on that. I don't know what percentage he's put down on those things when he's bought. But what I do see is I see a lot of inexperienced investors soliciting money. Ryan Pineda is probably, one of the most, Ryan Pineda was getting in a deal so bad that I did a video on it, and I had commented that he shouldn't ruin it. He's going to ruin his reputation. He shouldn't touch this thing with a 10-foot pole. And sure enough, about a year later, he's doing this WealthCon summit, which seems kind of funny. And he's talking about how he lost $1 million on, I think, that exact fund that he was proposing that would be worth much more. And then I think maybe one of you guys know that the guy that was trying to sell him on this fund or putting him in the deal. And I remember watching, I said, that guy knows what he's doing because he's trying to get it. He's trying to get rid of it with Ryan, and but I find out Ryan had to throw $1 million, of his own money, probably YouTube or wherever he's made his money from, and then he talked about doing a lot of flips. When Ryan Pineda says he's done 500 flips, I don't believe it. I don't believe any of it. But when he says he's lost money, I do believe that. And he did. He seems like a nice young guy. He was truthful talking about it, and I give him credit for that. But what people get in trouble with is people that, don't do their due diligence and throw in money with people that don't know what they're doing. And that is where it's a problem. So look, we can go here and a couple things. So again, tonight, the webinar, we'll come back here and we'll watch a little bit of this video on how real estate funds work, and I'll throw in my 2 cents. and we'll go from there.
It's the best thing I ever did.
You want to learn how to make millions of dollars in real estate? I've made tens of millions over my lifetime, and I'm showing people how to do it. Get in my free webinar. I have it every Thursday, 7 p.m. Central. Go to the link below, FlipAnythingUSA.com/webinar. Sign up for it. You can talk to me face-to-face if you want. Don't waste any time. Hit that subscribe button. Hit that like button. You don't want to miss my channel. I've been doing it for years. All right. So, look, I'm just kind of randomly grabbing this. If somebody wants to go take a look at something else, we can. Yeah. I just see some of the worst advice ever coming. But let's look at this guy. This guy doesn't have he's not trying to con people into getting into a fund. So let's take a look. We'll watch this for a minute. And I may speed it up just a little bit to get through it. Feel free to comment. Also, you can call in. Anybody wants to call in, you can call in the call-in number. Son, where's that call-in banner? Sorry, what's that? Oh, here we go. All right. Anyways, right here, if you want to call in, you can call in. We'll talk live. Look, if you just got here, please hit that subscribe button, hit that like button. It's funny. Look at Grant Cardone. Let's play this for a second. This guy's the worst. You got to watch this.
Buying a house, worst investment you'll ever make in your entire life. Let's say you paid $1 million to buy a house. Average house here is $576. $576 is what you paid. Now you need 12% for broker fees. Let's say you keep the house 10 years. You need 10% in maintenance fees. It's 1% a year in maintenance fees. It's about 2% in property taxes every year. That's 20%. 2 times 10 is 20. And it's probably 7% to the bank, so that's 70%. Total those up, it's 112%. $576,000 home will have to be sold for $1.2 million in 10 years. You're not going to sell it for that. To break even, dead money, and you had to put $100,000 down to do this. They're serving a master. They'll borrow money from the Bank of America, and then if they can get some more money, they'll have a little retirement account that funds Wall Street. This is a big game, bro.
Yeah. So listen, this guy's the worst. And he's the worst at math too, by the way. So of course, what did he leave out of the equation here? You got to live somewhere. You got to rent, right? In the home, to be honest, we've seen homes double in less than 10 years. Prices. It's not unusual. It's actually more the norm. But what did he leave out? He's not talking about. So it's the devil's in the details. He's not talking about you rent. You got to rent. You got to live somewhere. You got to live somewhere safe, right? You got kids. You got people to take care of. He left that out of the equation. And again, so compare. He's the guy that tells you, better to rent and throw your money into the best asset class in the world, which is apartments, where he can't afford to buy them by himself, so he looks to you for money. So, and it is a good deal because he's getting a piece of everybody else's action, and really, that's probably one of the key things. Particularly with Grant Cardone, he like I say, he was pretty good at, telling people buckle down, work hard, his 10 times thing. Extrapolated that to that he knew what he was doing in real estate. A lot of people bought it. Very similar to Pace Morby. I don't think Pace Morby, I got a video coming out on Pace Morby, by the way. If you know what you're doing in real estate, it doesn't take you very long to figure out that neither one of those guys are particularly talented or experienced. Anyways, let's watch the rest of this.
Rather than buying one house, rent where you live and take that $100,000 and go buy a piece of real estate where other people live. I just don't need to own a home on the way up. I need to own assets that pay me on the way up.
See, that's just a setup piece for throw in and invest with him. And I don't know anybody that's, I haven't seen any testimonials of people saying, gee, I'm so glad I invested with Grant. Look at all the money I made. In fact, I've seen just quite the opposite. So look, let's take a look at this other gentleman. Let me go back here and let's see what he has to say. This is
real estate funds.
I don't know this guy, and I'm not saying he does know, but let's just watch it together. This is how real estate fund works.
What are they? How do they work? and what are the pros and cons? That's exactly what I'll be walking you through in this video. And just in case we're meeting for the first time, my name is Seth Ferguson. I'm a 14-year real estate veteran. I'm the founder of the Multifamily Conference, a huge international apartment investing conference that's coming up in May 26th to 28th. And I also partner with investors to invest in large apartment buildings. So do me a favor, hit the subscribe button so you don't miss more videos about building wealth through multifamily real estate. So let's get right into it and talk about real estate.
So, of course, and I don't know this guy, got nothing good or bad to say about him, but anytime anybody's pitching you something with money, you need to see a track record of success, right? You need to see the money. And it'll be interesting, since this is what he does. He is looking for money, apparently. So let's watch.
Estate funds. Let's start with the first question. What is a real estate fund? What are they? Well, a real estate fund is really a structure that's employed to acquire pieces of real estate. So just like there's syndication, I'll put a link right up here to a video I did explaining everything you need to know about the syndication side. Just like syndication, a real estate fund is a type of structure, a way of structuring and layering different roles and responsibilities and who brings all the money, all of that sort of stuff. It's a way of acquiring real estate. So how do funds actually work? What are the different pieces and components that actually make this thing happen? So let's, this will be me getting the whiteboard really messy now. So there are two components to a real estate fund. So let's start right here. So this side is called the limited partnership, the LP, and this is made up of passive investors. So I'll just go passive investors, just like that. Unlike a joint venture or buying a property yourself where you're assuming unlimited risk, a limited partnership structure, an LP, actually provides the passive investors with a lot of protections under the law. So their risk exposure is not as big, and that's why it's called a limited partnership, because their risk is limited. This is really, really, really important. And I've done videos before, so I'll put a link right up there to one I did explaining about the differences in terms of risk between a joint venture partnership type of structure and some more sophisticated structuring like funds and syndication. What happens is these investors over here, they all individually have funds that they want to invest. Maybe it's 100 grand, 2, 3, 500, 800 grand, $1 million, whatever it is. And they want to be able to passively invest in real estate. They want to get the strong cash flow. They want to participate in the upside, the appreciation. They want all the tax benefits, but they don't want to devote the time, assume the risk, because, you know, they're busy. They're running their own businesses. They're busy professionals. Whatever they do to put.
Yeah, and the passive investors are usually, I mean, it depends. There's some very high net worth individuals that presumably they didn't get there by being stupid. They crunched the numbers. But there are, I can tell you, there's a ton of people that are moderately successful that get into funds that just get roasted. They don't understand money. They don't read the paperwork. They don't realize that they're throwing their money into something that will be tied up for as long as the general partner or the partner in charge, I should say. You don't necessarily have to be the general partner to be the partner in charge, by the way. But that control, and that lack of control that you as an investor have is horrible. You put 100 grand in, and somebody else has control of your money, and they don't want to sell. You're stuck. I mean, you can't get out. You don't have the ability to do anything to get out. And so that's why I teach everybody that's in my class, you hold the reins. If you got to hold the reins. Now, once you really can prove your worth, that you know how to make money, then it's one thing to take other people's money and invest it. But like Chris Crone, for example, I haven't seen any credible evidence that he knows what he's doing as an investor. He looks like he buys property full retail with other people's money, but he doesn't do that so much now. Why? Because the math doesn't work. If people got to throw in 25% down on a house today, it doesn't give you any kind of return at all, basically. In other words, there's no return. So he can't make it work with 25% down. Even with 50% down, it's a little tougher, and it's because the interest rates have doubled. So anyways, let's keep watching.
Bread on the table and advance their career, they're busy doing that. They just want to put their money to work and have it run by a professional management team who knows real estate, who has the connections, who hunts the deals, all of that sort of stuff. Plus, the management team assumes greater risk. We already talked about the risk. So these investors, they pool their funds together in the limited partnership. Now, these funds are actually controlled by what's called the fund manager.
So I'll just put their risk is a bit minimal. Just so you know, the people managing their risk is quite minimal.
Here, just to keep things keep things simple. So like I said, the fund manager, the management team, the general partnership, they have the track record, they have the deal flow, they know what markets they're in, why they're in those markets, they have the business plan, so how they're going to create value in real estate. And I'll put a link right up here to a video I did explaining all about the value add strategy, so how we force appreciation with apartment buildings. So the fund manager, they have all the experience, they bring everything to the table, but they don't have the capital required. And this is what the passive investors bring, the limited partnership. And the fund criteria basically outline, the types of deals the fund's going to be acquiring, the areas, the rough business plan. So basically, these investors, they review the fund criteria and say, you know what, this looks really good to me. I'm really happy with their experience. The fund manager, I'm confident in their ability to perform based on the fund criteria. I'm going to invest my money. So the limited partnership here, they will invest their money under the control of the fund manager, and then the fund manager will then go out, the fund itself will go out and acquire property. So this is...
And this is where the devil's in the details, is with the fund manager. And this is what you need to know. You can put the shittiest fund in the world together, and you as the person that put it together, you can make on average, $200,000 to $400,000 a year off of every $10 to $20 million that's in, that you've accumulated from others, because you charge 2% to manage the fund. So the incentives are really screwed up for a lot of these funds. They're really, really screwed up.
Is the fund itself. So with the syndication, usually I draw a single building because a syndication is for a project, a deal-by-deal basis. With a fund, basically what will happen is the LPs are plugged in here, the fund manager is plugged in here, and the fund will actually go out and acquire a deal. So they'll buy a deal, and they may buy another deal.
Yeah, and see, this is the other devil in the details. So you got guy out there soliciting money, and the one that's managing it, they're getting into multiple things. These guys are incentivized to go find something to buy. I've already seen it. I mean, I saw a lot of this actually in the 80s, and a lot of people went belly up as a result. They were buying bad deals, left and right. And now we're kind of in a situation where if you bought a moderately bad deal or a deal that was just simply mediocre, and like borrowing money, a lot of people, they'll have their money called in 5 years. When you're smart, when you go to bargain for that money with your bank, you'll put a cap. In other words, a lot of people don't even think about it, but you can put a cap. You can agree that, hey, in 5 years we'll adjust it to the market rate, but it won't be in excess of 1%. So in other words, instead of rates going from 4 to 8.5%, like that's what's happening to many, many people that supposedly know what they're doing, right? That's happening too right now. But if they had put a cap, if they had a cap built in to where the bank says, look, listen, the bank's in the business of loaning money. I teach all my students, listen, when you go into a bank, don't be intimidated. You're shopping. You're looking for money, and they're there to sell it to you, right? And so when you tell them, you can do much better than most people realize, and than most people do, but you can put a cap on the rate. In other words, you can put a cap on it, saying that in 5 years, but there'll be a cap in 1 year, or a 1% cap, so it can't go up any more than 1% after 5 years, and then it's everything's negotiable. So let's keep watching.
And then they may sell a deal at some point. And the fund basically has a life of its own. And some funds can last for 10 years, 15, 20, 30, 40 years, 50 years. So a fund is really like an entity or has a life of its own.
So remember that a fund can last 50 years. A fund can last longer than you, okay? And you may not have control of the money or be able to get out. So that's a good point that he said. But again, like he says, the beauty of this, listen, and I've never done a partnership that I didn't have 100% control because nobody does better than me. I mean, I could never invest with anybody because I don't know anybody that does as well as I do. That's simple. And so as an investor, of course you want the flexibility because this is the beauty of being an investor, is having the flexibility to change your asset. In other words, to grow, to jump to something bigger and better. And I want to give you an example of that too. So look, I own a lot of property, right? And if you go back in the sky here, you can see every one of these properties you see around me and above my head. I bought every one of those properties. And it's really a lot of property. It goes in each direction. It's a long string. And the types of properties, right? So I'll give you an example just to run you through some of this. Like, I'll show you a little building. Here's the building I bought. I think that's it. Yeah. So look, here's a building I bought for $240,000. And be sure, if you guys want to call in, you can call in, by the way. But also, don't forget this. So here's a building. I bought this building for $240,000 and made about $60,000 to $90,000 a year after I bought it on rents, right? Well, when I did sell it, I sold it for $1,725,000, about $1.5 million more than I paid for it. I've made far more than $1.5 million on it, but $1.5 million. Now, why would I get rid of this building? It's well located. Even though it's sitting in the back, that doesn't matter. Today's day and age, everybody can find you. Everybody knows where you're at, with an app. It's just not, it's proximity to freeways and this sort of thing. See the freeways? This is an excellent property because when you leave this piece of property, and by the way, this is a lesson in itself, so pay attention, please. When you leave this property, you can come out, you can come over, you can go to this bridge, and you can go either direction, right? Or you can go this way, and you can see this huge confluence of, this huge arteries of freeways. You can go out this way, and you can go either direction. So the location is excellent for getting out of the property onto a freeway and on your way home very quickly. There's many situations where people pull off, they go to work, and it takes them 5 minutes to get turned around enough on the freeway that when they're coming back, they're looking at their office 5 minutes after they left. And I know a lot of you know what I'm talking about. And hopefully you won't have to do that grind for much longer. Make some money in real estate and you'll be free. But again, but I'm getting back to I have probably 17, maybe 20 limited partnerships. Some of them own multiple buildings, some own individuals that are very valuable properties. But a property like this, the flexibility of being able to manipulate that money is very important. Like he was describing a minute ago. Let me go him. Where is he? Yeah. The manager being able to, and this is why, you be your own manager. You don't need to be part of something big where somebody else has the control. That's a killer. You're better off having something small that you have 100% control, and you'll make a hell of a lot more money. Pro rata, this would never keep up with what a decent investor can make on his own. But my point is that I sold this property, and the reason I sold it was to buy something much, much better. And let me see if I can show you that real quick. Yeah, so why would I sell that? Because they'd say, why'd you sell that? Well, again, quite simply, to buy something that was much better. Yeah, I have to do it from the sky. Yeah, right here. Here it is. I took that $1.7 million, so I made $1.5 million on that, right? And then I bought this building. Well, the day I bought this building, I made $1.2 million because I bought it for $1.2 million under market. And these are beautiful assets. This is a strip center. This is this highway here is, you can see it's 5 lanes. Actually looks 5 lanes. And, very close to another freeway. All this stuff is very important. But these things are gold because, they're Amazon proof. They're goods and services. There's, this one, we got karate school, hair people, veterinarian, massage parlor. I think we got a vape shop in here too. In other words, these kind of assets are smaller, but they're within the reach of an individual, right? If you do it right, you can parlay, and you can own something like this, and you can own something much smaller than this. You could own like this little building across the street, which actually this is a nice little property. I wish I would have bought it. A little tiny house that has been converted to commercial. And now this thing makes $1,000 a month. But that's what's so important about controlling the cash yourself. Controlling the asset. So anyways, it's something you don't have when you throw in one of these big funds. And like I say, here's the other thing. If you went into a regular partnership with somebody where they didn't have all this fund manager stuff, right? Where you don't have a management, a manager that's taking 2% a year on the total fund value, 2%, right? On $10 million, $200,000 a year. there's no incentive to sell. There's no incentive to do what's really best for everybody else because you're kind of sitting fat. You know, every 10 million, you're going to get another 200 grand. So anyways, let's keep watching.
Grow, it will shrink, it will expand, it'll go through different periods of the fund. And basically what will happen is the passive investors, instead of investing in a single project like with the syndication, their money is diversified throughout the entire fund. So let's say the fund has 50 properties or 20 properties. The limited partnership actually owns pieces of all those different properties. It's not just a single property like with the syndication. And of course there's profits, right? So, and of course, there's profits, right? The fund, the whole idea of the fund is to put the money to work and make it profitable for the limited partnership, the passive investors. And profits are paid out according to what's called a split. So one split could be 70-30 with one fund, so meaning that 30% of the profits go to the fund manager for running the deal and all that stuff, and then 70% goes to the limited partnership. It could be 25-75, it could be 60-40. It really depends on the types of deals, the risk exposure.
So it's funny. I did a video on Grant Cardone, and he was actually in a very desperate mode. In fact, you might remember
you
this.
got a good attitude. You ain't a little bitch. You ain't a little baby. You ain't cry baby. You ain't stupid baby. You ain't dumb. Yeah, I need my money. I got to buy a Rolex.
Anyways, it preceded that little clip from Grant Cardone, and you could tell this is just around the the COVID time. And he was freaked out. And he just kind of fell to pieces. But he had talked about how he had just cut a check for $1.2 million to the investors and $800,000 to himself. Well, that's a 40-60 split. And so I went on to him and says, well, what is it? What is it, Grant? You got 40%. What did you do for your 40%? And that's the problem with these types of things. Sometimes that guy's got no sweat in it. He's really maybe just a mediocre amount of profit. Anyways, consider that everything you buy, it's just numbers. It's not hard to figure out. If you're going to jump in and pay, sometimes it's worth it for, somebody to put all the money in, if the reward is big enough. But many times it just is not.
There for the general partnership as well as for the limited partnership, the time, energy involved, many different factors go into determining what's called a split. And of course there are fees being charged. Typically there's an asset management fee, so a percentage of the total dollar volume under management. That could be 1%, 2%, 1.5%, whatever it is. And there are other fees built into the deal. I don't want to get too bogged down in the fee side, but basically what you have to know is that the profits are paid out according to...
So listen, and no disrespect to this guy, but you should get bogged down on the fee side. Because the fee side is going to be the incentive or disincentive for somebody to do something with the fund, right? In other words, for everybody to get a payout, you got to sell at some point. There's no incentive to sell if the fund manager is continuing to get a very, very nice return. He's got no sweat in it. He's got no money in it. In other words, if he had $1 million or several $1 million involved along with the other people that have, maybe 10 million collectively, he'd be more incentivized to sell the thing. So it's important. It's very important that it's just math, but it's something you got to look at. Anybody got any comments on that? You can also call in if you want. I'd be happy to talk to anybody. Make sure I'm keeping an eye on that. Calls. Anyways, so let's we'll watch a little more of this, and then anybody want to talk about anything, just go right ahead.
A split, and then there's fees that are charged as well in the fund structure just to support the fund and make sure it's able to go out and acquire more properties and really do what it's built to do. So let's get into some pros and cons with the fund, and I've kind of dropped a couple as I went through the video here. So let's do some pros and cons. Let's start with the cons and then we'll switch over to the pros. We'll mix it up from the way I usually do it. So some cons with the fund. Well, if you are an investor who wants to have control, ultimate control over exactly where your money goes, so you want it to vet every single opportunity, a fund won't give you that because your money, you are investing your money in the fund. You have your fund criteria that you're subscribing to, but then the fund manager will go out and use and deploy your capital as they see fit. So if you want to know exactly what deal they're doing and how your money is being deployed, well, a syndication is probably better for you because with the syndication, you can say, I really like this deal. I want to invest in this one, or no, this doesn't really fit what I'm looking for.
Yeah, syndication isn't necessarily give you just automatic freedom that the other one doesn't. Syndication can still be, quite confining as well.
for I'll pass and bring me the next one. With a fund, you don't have full control of how your money's deployed because that's what the fund manager is paid to do, to go out, put your money to work in the way that they feel is best for you and the fund as a whole. Another con with the fund, and this kind of goes hand in hand with syndication and more sophisticated structuring, is not very liquid, right? So it's not the type of investment where you can invest one time and then 6 months later you want to exit. These are long-term real estate investments, and typically you're in the deal for 3, 4, 5, 7 years depending on
some 10, sometimes 20, right? So you got to think about that. Especially the older you are, the more you want to consider that. You got to have an exit strategy, and so very, very important. So I appreciate him pointing that stuff out.
On the type of fund or the type of syndication, that sort of thing. So they're not very liquid. Now that is a big benefit to a lot of people.
And they're not very bankable. And if you want to borrow money from the bank against this, maybe you have $500,000, equity in a fund, they're not going to respect it. They're not going to loan you any money on it.
But also it could not be a benefit, and it could be a con if you're looking for that sort of thing. And then the other con I just want to talk about is funds are not accessible to everybody. Generally speaking, you must be an accredited investor if the fund manager is going through the exempt market, and that means there are income requirements to investing in a fund, these types of deals. Like they can't be...
Sometimes, believe me, sometimes you not qualifying for a fund would probably be the best thing in the world that could happen to you. Because if you can't qualify to be in a fund, if you're not an accredited investor, not liquid to $1 million or something like that, you don't really have any power. If they don't do things right, they do things wrong. You don't have any. In other words, you don't have any. You don't have the ability to get a lawyer and put some pressure on them. So you got to think about that. You got to think about that.
Publicly advertised most of the time if they are going through the exempt market in terms of raising funds. So they're not accessible to everybody. And like I said, you have to hit income or net asset requirements to be able to invest. Now let's talk about some pros, because there are a lot of pros to either investing in a fund or launching a fund of your own. Well, the first pro would be the money is there when you need it. So unlike a syndication where you acquire the asset, you lock it up, and then you have to raise the funds, the money's already sitting there in a fund. So oftentimes, depending on market conditions, you can use that to your advantage and pull the trigger pretty quickly and be able to close very quickly. And depending on...
So he's talking about from the perspective of the fund manager, the money's sitting there in the bank and it's there, the cash is there. And so look, and I've had, really what he's describing is the manager kind of has the control as if he owns it himself. And really that's where I want everybody to be in general, that I teach anyways. Like you saw, I sold a property, I bought a property, right? I had cash, boom, I paid for it. I got a property for $240,000, and that day I probably made $800,000. It went up a little bit more from there, and I made over $1.5 million. Then what did I do? I found another building, got a great deal on it. Boom! I pulled the trigger. I sold the property for $1.7 million and made $1.2 million the day that I bought the other property. That's the advantage of controlling the assets yourself, and it doesn't matter if it's on a smaller scale. If it's a smaller scale and you own more of it, or maybe you own 100% of it, it's a very good way to go. So let's keep listening.
On the situation, that can prove very advantageous in terms of the terms you are able to get for that acquisition. And then diversification, I already mentioned that, but instead of investing in a single deal, your investors all their exposure is in that one deal. With a fund, you're diversified across the entire portfolio. So that could be 10 properties or 20 properties, 50 properties, 7 properties, whatever it is, but your money is spread out, or the investor's money is spread out. And that could be in just one market, that could be in many markets. It all depends on what the fund, what their business plan is, and what the criteria state. And the last advantage I want to talk about is when you're a passive investor with the syndication, you invest your money, and then when the syndication, when they wrap it up, when you exit that deal, you have to find another deal to put your money in. With a fund, you invest in the fund and your money just keeps working. It moves from one deal to the next deal because they're all happening inside the fund. You're not out shopping for the next deal because the money's already there and it's already working on the next deal. So it is a different way of doing things if you're used to.
Yeah, so the fund manager, that, like I say, he's got the power to liquidate and buy something else, which is really important. And but again, if you're going to invest in a fund, whoever is in control, whoever's basically the fund manager, right? Or if you're just in a civil partnership, and whoever's in charge of that asset, if you're going to throw in money, they need to have a track record of success, right? In other words, you want to see testimonials, you want to see bank statements, you want to see that they've actually done things that make them credible. Like, I remember a young guy telling me, if I just had $400,000, I could make so much money. He's talking about making his parents some money and this, that, and the other thing. And I said, listen, last thing you want to do is borrow $400,000 from your parents, because you don't know what you're doing. He goes, well, what do you mean? I said, well, what experience do you have making money with $400,000? And he goes, I said, have you ever made any money with $200,000, $300,000? Have you done it? Have you ever done it? He had never done it. If you've never done it, folks, you don't know what you're doing. You have to be able to prove that you know what you're doing. And when you go out there and you spend money with somebody or invest in a fund with a Grant Cardone, Pace Morby, or one of these other guys, what you need to do is say, why should I trust you? Why should, show me something. Show me the profit that you made on something, right? Show me why I should believe that you have a track record. Not just a one-time hit, right? Anybody can get lucky once. You want to see a long track record of success to establish that this person actually does know what they're doing. Anyways, that's it. I'll leave it here for now. I'll check back with you guys maybe a little bit later. Anyways, hey, tonight, 7 p.m. Central. Get in, you can talk live with me, and I'll show you a webinar. I'm going to show you, how I made, fortune in real estate and how you can do it too. All these properties, like I say, all these and many, many more. This is when I was making tens of millions, and prior to that, I can, show you back when I started, way back when, back in the 80s when I started. The same thing. You can see all these properties. This is what made my first million. Way back when. And, back in 1981 is when I started. And by the way, interest rates back then, they were 10%. And by the way, every time you see one of these blue dots back here over on this side, it represents 6 properties, right? So there's probably, about 70 properties in this area that I purchased, and made money just on every single one of them. How much does your mentorship cost? Well, you know what? I'll tell you what. You have to take the mentorship survey, right? I'm glad you asked that, by the way. Let me go to Flip Anything. If you go to Flip Anything USA, you go in here, and up here at the top, you'll see apply for mentorship, right? In other words, I don't have a sign-up place, a place for you to sign up. You have to fill this out. It's not quite a resume, but it's basically share a little bit about yourself, stuff that's important for me to know. Because I don't want you in the class if you're not going to be successful. If you're going to fail, your failure is my failure. I don't want you to fail. So I try to, I vet the people that I let in the mentorship. If I don't think you have a good, mindset, if I don't think you don't have enough money, and it's not that you have to have a lot of money, and I might charge somebody that's, already established and has, millions of dollars. I might charge them, what I consider the full price, and you might give me, somebody younger that doesn't have as much money, but they're bright, they got a good mind. I may give them a better break, a better deal. So hope that answers your question to some degree. But anyways, the other thing is the webinar tonight. Get in the webinar, and this is very little form. Just fill that out. Put your phone number. I'll text you the link to get in if you want that. Otherwise, some things get lost in email. They get bounced out. We'll send you a phone link so you can get in as well. But the other thing you want to get away is with you want to get my book. My book, Wake Up and Smell the Real Estate. Like I say, it's been a bestseller on Amazon, Audible, and Kindle. And I got many millionaires in my class. In fact, that's one of the things you should look at when you go to my place. Go to FlipAnythingUSA.com. Is just take a look at the money's made. Jerry here, he scored big on this one. I won't represent this as being the norm, but it's not impossible. He made over $2 million on one deal. Many, many six-figure flips before that. Almost $1 million here with Josh. This guy here, he made over, I don't know why his name escapes me for the moment, but a super great individual. Let's just play it for a second.
Yes, I'm close on it now. I'm painting now, and don't have probably another 3 weeks, and it'll be listed. Should make at least 100.
Tom here, Flip Anything USA. Got a very special guest here. This is Shane George. He's a fantastic student. He's already look at Shane here. And by the way, he made $13,000 on his first deal. He made $100,000 roughly on his second deal. Made another $100,000 on his third deal. So $239,000 or $249,000 or $213,000, I should say. In less than a year. And he made 113 of that in 7 months. And like I say, got people that, like Rich here is, made almost $1.4 million inside of 18 months. Chris here, a couple $100,000 this year that I know of already. He actually quit his job. He quit a $60,000 a year job, and now he's a full-time investor. And then watch these testimonials. These are real people, just like you and me, that have changed their lives by just getting a little bit of guidance and getting a little bit of skills. It goes a long, long ways if you do it right. So, so again, please get in the webinar tonight, and appreciate you watching. Hit that subscribe button, hit that like button, and hope to see you again soon, if not in the webinar tonight at 7 p.m. You want to learn how to make millions of dollars in real estate? I've made tens of millions over my lifetime, and I'm showing people how to do it. Get in my free webinar. I have it every Thursday, 7 p.m. Central. Go to the link below, FlipAnythingUSA.com/webinar. Sign up for it. You can talk to me face to face if you want. Don't waste any time. Hit that subscribe button, hit that like button. You don't want to miss my channel. I've been doing it for years.